All right, what is up, tycoons? What's up, traders? Super excited for today's video. Coming at you guys with another viewer request. We're actually going to take a look at Amazon today. Now, Amazon recently reported earnings. We're going to break down, some of the key things that I'm looking at on the charts. We're actually trading in a range right now from the pre-pandemic highs and the pandemic lows. If you look, that's really where we're consolidating, and that is our range that we've been in since the about October of last year in 2022. We're also going to take a look at the financials right now, okay? And that is a shout out to today's sponsor, which is Simply Wall Street. More on them later. It's a really great resource that you guys can use to find out some financial, data and resources, and they have really nice graphs as well that go along with it. And then we'll take a look at some other chart patterns that we have here developing on the daily time frame, the weekly time frame, and more. So the content provided in this YouTube channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. Myself and any individuals that appear in this YouTube channel are not registered financial advisors. Trading in stocks, bonds, commodities, and crypto involve a significant risk of loss and is not suitable for all investors. So be sure to read through the full disclaimer before moving forward. And we'll go ahead and start off here with the pandemic range, right? So the pre-pandemic highs were roughly 109.32, and the COVID lows, the pandemic lows, were roughly $81.25. And you can see we've been trading in between this range now, and we did wick out above it a couple times here on the weekly time frame, but we have not been able to close above there on the weekly time frame. Right. And we're really just trading in this range for now. And there is a possibility we could head back downwards as we are at the top of the range. So that's something you want to keep in mind. You can see, before COVID, we actually, traded in this range for a long time, for an extended period of time throughout the entire year of 2019. So it's very possible that we could do the same and really just stay within this range as economic uncertainty is very unclear right now, moving forward, especially with interest rates and inflation and the job reports, the labor market, and lots of different things going into what could possibly keep us in a range. Now we could break out. That's definitely very possible. We'll go over some of the different possible scenarios for that. If you actually take a look, all right, a lot of analysts are saying that Amazon is now currently 22% undervalued and that the fair value is estimated to be $135 per share. Now, over the last 90 days, the stock is up 3.1%. Revenue has grown by 18% over the last 3 years. Meanwhile, the company has become loss-making. Now, from a valuation standpoint, all right, they get a 5 out of 6 on the valuation score, right? Their price to sales versus their peers is very good. Now, the price to sales versus the industry, that's really the only thing that they get a negative score on here. You have the price to sales versus fair ratio. It's also below fair value. We have significantly below fair value, and then an analyst forecast. These are all bullish, okay, on the valuation side for Amazon. If you take a look at the PEG ratio right now, currently it's at 7. Future growth gets about a 3 out of 6. Okay. On the good side, we have the earnings versus the savings rate, earnings versus market, high growth earnings, revenue versus market, high growth revenue, and future ROE is where we get the 3X's at. All right, some of the key information is we got a 36% earnings growth rate and a 34.7% EPS growth rate. That is your earnings per share. And if you take a look, the analyst coverage is good here, and lots of analysts are saying that it is about 22% undervalued. The financial health is also actually pretty good as well. If you take a look when it comes to value and when it comes to financial health, that is Amazon's pretty much strongest points right there. The short-term and long-term liabilities are, an X right here. So those are some things that you have to keep in mind. But when it comes to the debt level, all right, and reducing debt and debt coverage and interest coverage, those are all positives on Amazon. Now, all of this data is from Simply Wall Street, which is actually today's sponsor. There's a link in the description. There'll also be a link for a pinned comment. You can actually dive into each one of these, right? So you can click on the price to sales versus peers. You can click on short-term liabilities, and you can go even further in. And it makes everything super simple for you guys to understand. They have some nice graphs that come along with it, whether it's bar charts or pie charts, sometimes even line charts. and they explain things very nicely to you guys in a very simple manner. If you use the link, all right, my link to join in the description or in the pinned comment below, you guys will get 14 days free, right? So you get a 2-week free trial and you can use it. I have been using this for years now, and they're, finally sponsoring the channel now that I've got a channel. All right. And, the first 100 people to join, they're actually going to be eligible for up to 40% discount. All right. So I definitely recommend using it. It's something very nice and will, just give you some good insight, right? Maybe you're not too good at reading financial statements or understanding company fundamentals. Simply Wall Street is going to be there to help and really break things down for you guys in a very simple manner. So I highly recommend using them with the links in the description or the pinned comment below. Now let's get back into some TA now that we've covered a little bit of the fundamentals. One of the first things that I want to cover here is this large macro weekly chart, head and shoulders we have possibly forming here, right? So we've got a left shoulder here over here in this pandemic range right here, and look at where we're at right now. So if we continue to consolidate in this range right here, all right, we're going to end up putting in a right shoulder. So that's something we need to be cautious of. And if this is going to be our head and shoulders pattern, this is the neckline that you would need to be really cautious of. Now, for this to happen, we essentially would need to see another massive leg down in the bear market. Now, a lot of people are confused if the bear market is over. Has the new bull market started? Q1 of 2023 has been extremely bullish. Even if you take a look at Amazon, right, in the beginning of the year, Amazon was very close to these $80 price levels and has already shot up, above $100. So it's very tough to predict the future. All you want to do is prepare yourself for certain scenarios, so that way you're not caught by surprise, right? So this is one thing that I'm paying attention to right now as a possibility. If the bear market really continues and let's say the S&P 500 or the NASDAQ retest some of its previous lows or potentially break some of its previous lows, these are some chart scenarios that could end up playing out, right? So you need to be cautious and be a little bit aware of those. If you take a look at the next one we have, this is actually the weekly chart again. And, we could actually be forming an inverse cup and handle right here, right? So, we very clearly have a cup, right? And we've gotten this bounce up. Now, if we don't continue to head in an upwards direction and we actually come back down and retest this $80 price level, about $80 to $85, we're actually going to put in a handle here for an inverse cup and handle. And essentially, if we break 81.25, most likely we would see a sharp move to the downside. So, that's another thing that you kind of just want to prepare yourself. Now, it's not all doom and gloom. All right. Remember what the financial analyst said is that they think it's undervalued and they think that it has a value of 135, right? If we zoom out of here real quick and go back to that, all right, I'll show you guys just so you can see. And let's go back to this one. Over the last 90 days, the stock is up 3.1%. The fair value is estimated to be $135. Now, why am I showing you this, right? Why is it significant? If we actually go here over to the daily time frame, we have what's known as a gap. Okay, so that's what this blue box is right here. See how there's a gap in between this candlestick and this candlestick right here? These gaps, they fill about 90% of the time historically. Now, the big question is, when are those gaps going to fill, right? So if you take a look, like for instance, right here, we have this huge gap. And look what happened. It ended up filling over here, right? So, we filled this gap. It took a while for the gap to fill, but that gap did end up filling. There's been multiple times where gaps have filled on the chart. All right. There was a gap over here. That gap ended up filling. Okay. We had a gap down right here. This gap ended up filling. So, these gaps, they do tend to fill. The big question is when they're going to fill, not if they're going to fill. So if we continue to see a bullish market cycle, it's very, very possible that a lot of these analysts are correct in that we are going to see Amazon at a fair value of about 135. And we also coincidentally have a gap up to fill on the chart at 134. So that's something that you can look for. Now, ultimately, Amazon is not really going to be bullish until we're above $127.74. Now, you may be saying, what am I talking about? Look at this tremendous rally that we've had off of the lows. But this is just, simply a fact, right? And the reason being is that is our 61.8% retracement level, right? There are three major Fibonacci retracement levels. You have the 61.8, the 50%, and the 38.2. Now take a look here how we rejected the 50% Fibonacci retracement level very hard, and saw a steep decline afterwards. All right, we haven't been able to get back above there. So if we measure the move, right, we had the strong move to the downside. We retraced up to the 50, we came back down, and now we're approaching back up to the 50% retracement level. You use the fibs to identify trend continuation, right? Because nothing moves in a straight line down or in a straight line up. Rather, you'd get a move up, retracement, continuation of the trend, or move down, retracement, continuation of that trend, right? So if we look here, we've had the move down, we've had a retracement, and we can even head all the way up to 121.74 and possibly still continue that downtrend. Now, you can spot reversals also using the fibs, right? So if you break through your Fibonacci retracement levels, you can spot a potential upside reversal, right? So, if you move down, retrace, and you consolidate through there and break through, that's how you would spot a potential upside reversal, right? And we're showing signs of potentially doing that, right? We've had the big move down, retracement, and now we're starting to consolidate around these levels. If we can really break through and flip 121.74 to support from resistance, we do have a strong chance of filling that gap up at 134. Now, there's a couple more things you need to be cautious of, okay? One in particular is the bump and run chart pattern. This is a reversal bearish chart pattern. So you have this leading prevailing uptrend, right? Which is what we've got here. And then you get a short bump in the price of the stock, right? And so that's what we're seeing here. So we have, the leading uptrend, and then we have the bump. If we were to break this trend line here, most likely we would retest some of our previous lows, as that is how the bump and run patterns happens, right? So we're currently in the bump phase, and the run would take us back down to where the pattern began. So that's something we do need to be cautious of. Now, you could also call this a rising wedge, okay? So if you take a look at this trend line here in blue, along with your bump trend line right here, that is forming a rising wedge. And if we break this trend line here, we need to be very cautious, because that would take us down to where the pattern began, which is going to be roughly right over here. Let's call it about $92 on Amazon. Okay. Now, that would be even more significant, because then that might confirm the bump and run pattern, right? You see how you're going to come down and test the trend line and then retest it and then get the actual rest of the run pattern, right? Your initial entry is right over here with the stop loss up above, and then you take profits down here on the trend line. And then you go for another entry at once you're over here on the chart. So, that's something that people need to just be cautious of. Okay, I know the market's been really bullish right now. Things can change at any time. All right. And there's a lot of uncertainty going on right now. Okay. So hopefully you enjoyed this video. All right. If you did, smash that like button, subscribe to the channel so you guys don't miss any more. And remember, all right, use the link in the description or in the pinned comment below and join Simply Wall Street. Okay, you guys will get 14 days for free if you use my link. So that way you can test it out and try it yourself. And the first 100 people to join will also get up to a 40% discount as well. So, use that, support the channel while also supporting yourself and getting a really, really useful platform.